Two undervalued stocks to consider in June of 2024. This is a series that I do every month discussing two undervalued stocks, but I have to admit it's been getting a little bit challenging to find undervalued stocks that I've never talked about before, but I have one of them that is finally getting into undervalued territory. It's a stock that I'm extremely interested in, and a super investor recently bought the stock, which is pretty good. The second one, I've also talked about it. I made money with the stock. I might be buying it again. It's more of a high quality company getting pretty close to fair value. I'm going to discuss both stocks in today's video. If you do enjoy it, all I ask is please press the like button and maybe leave a comment and let me know what you think of the video. Now, the first stock, which I talked about before, and after I talked about it, a popular investor bought it, Terry Smith, and this company is CHH Choice Hotels. Now, this is a weird combination of some quality that's also undervalued. Most quality companies, they tend to bottom at fair values. They barely bottom in undervalued territory. But this is a very special example of a quality company. And Terry Smith, if you don't know him, he only buys quality stuff, good companies, good management, high margins, high return on capital. And this is what this company is, which doesn't happen very often. And this is Choice Hotels. And if you look at this chart of the company, it's been flat for a few months. A lot of technical analysts may agree with me that it could be pretty close to a bottom based on a previous trend. But it has been stuck in this trend because of the merger that they were trying to do with Wyndham Hotels. They were trying to merge with them. There was a lot of uncertainty, so the stock was bouncing up and down. But now the merger has been called off, and it's not going to happen. But Choice Hotels is a company that owns, you could say, lower to mid-tier brands. It's nothing, nothing luxurious, nothing, 5 stars or diamond style or anything crazy. They have things like the Counter Inn, Comfort Inn, Quality Inn, even, Park Inn, Clarion, which maybe a lot of you know. Even the very cheap stuff like the Eckno Lodge and Roadway Inn. It's really affordable kind of hotels. This is what this company has. It's not much on the higher end, although they've been trying to enter the space a little bit more with Cambria Hotels and some other slightly better brands. But most of their brands are just, very cheap, affordable hotels that people stay in overnight if they're driving from one state to the other, or it's just a cheaper option in general. Now, normally hotel companies, they have a lot of expensive, and they have very low margins. But this is not the case with Choice Hotels, and this is why it's more of a high-quality company, and Terry Smith bought it. And if you look at the revenues for 2023, they made $1.5 billion in revenues. They grew 10%. Now, out of the $1.5 billion, around $600 million of the $1.5 billion is recurring revenues. They have $513 million in royalties, licensing, and management fees because a lot of operators, they operate the hotels, they pay them royalties, just like they pay McDonald's royalties, just like a lot of the franchises earn royalties, high margin stuff, not much capex up front. It's the same thing with Choice Hotels. $530 million is from royalty fees and other management fees. $75 million is for platform and other kind of fees. So if they want to use the software on the front desk to check in, check out people, use the systems, the payment systems, and all these kind of things, Choice Hotels, they have to pay them, fees. So they have around $600 million out of the $1.5 billion recurring revenues, very high margin stuff. And this is something that they're going to get pretty much no matter what, which adds more stability to the free cash flow profile and the profit profile of the company. They have around 20% net income margin, not bad for a hotel company, but it's mainly because of the amazing business model of collecting the licensing and, franchising fees. They also have pretty decent return on capital. It used to be 34%, now it's been 24%. Something else that Terry Smith looks for whenever he's looking for a quality company. But again, this is a quality company trading at a discount, which doesn't happen very often. But for the last quarter, the company also did very well. In Q1 of 2024, they grew revenue 16%, adjusted EBITDA grew 17%, adjusted earnings per share grew 14%, and it was amazing. They did very, very well. Now, I showed you all these things. I showed you all the growth. I showed you it's growing 14% earnings per share, 20% net income margins, high return on capital. Terry Smith bought the stock. It's a quality company, good business model. You might be thinking this company is trading at 20 or 25 times free cash flow, but it's just nowhere close to that. It's trading at 14 times. It used to trade at 25 times. That was a while back. It traded at an average of 25 times. But now it's trading at 14 times free cash flow, pretty much a record low for the company. And this is for two main reasons. that I'm going to tell you in the video. And if those two reasons are fixed or the market goes beyond them, I would expect a massive multiple expansion. Maybe not from 14 times to 25 times, but maybe back to 20 times or 18 times. And this is alone massive upside potential on this company called Choice Hotels. And the first reason is trading at such a low multiple, a record low multiple for the company of 14 times free cash flow. The main one is the debt. They do have a lot of debt. They've been mostly buying back stock, which is good. It's good to return value for shareholders and expand earnings per share. They bought back a lot of stock, but the company hasn't been too disciplined with paying down the debt. And now they have some debt maturities maturing very, very soon. The company makes like $320 million in free cash flow, and they have a small dividend. But for example, this year, as the first line you could see, and this one is due in 2024, $499 million. So they have around $500 million due in 2024. The other one is 2031, 2029. So nothing much in the short term. The main one in the short term is $500 million. But they don't have enough cash to cover it. They have like $10 million of cash. And the free cash flow is not enough. And in Q1, they used the free cash flow to buy back stocks. They bought back, pretty close to 3% of shares outstanding in the first quarter alone. So they're not even using the free cash flow to pay down the debt. So this is one thing the market freaks out about. But for Choice Hotel, it has an amazing business model, and the free cash flow has been pretty resilient. So for me personally, I don't think the stock is going to zero. They can refinance the debt and move on. The management is not stupid. It's very smart for Choice Hotel. They're most likely working on refinancing this debt. If they weren't, I'm sure they would not have bought back stock in Q1. So again, this is something the market freaks out about whenever you have a lot of maturities in the short term and the company is not being disciplined. But I'm pretty confident this $500 million, they're going to refinance it. And they're already paying 6.7% interest. So I don't think the interest is going to be that much different, maybe 7% maximum. So it's not going to make a huge difference in the free cash flow profile or net income profile of the company. So this is what I'm saying. This is the first reason, and it warrants a multiple contraction, of course. The second reason is they expect very little growth for 2024, and this is a slower year in general, not just for Choice Hotel, for a lot of different companies, a lot of retailers. People aren't doing what they used to do before. Things are very tight, student loans repayment, 5.5% interest rates, and we still have decent inflation too. So things have been slow in most retailers and most places in general, and they expect revenue growth flat to 2%, which is almost nothing. And this, of course, will warrant a multiple contraction for the stock because Choice Hotels used to grow around 7%, 8%, 7%, 13%, around 7 to 8% on average. Then they grew massively, and now they're around 2%. Now, if you just look at the trend in general, there's something called reversion to the mean. The mean was around 7 to 8%. Then it declined 30%. It went up 38%. Then 31, then 10. I don't think this was sustainable. So of course you're going to have maybe a year or two of 2% growth, and I will most likely be able to get back to 7 to 8% revenue growth over the very long term. And this is just in revenues. So to make the thesis very, very short, the two main reasons why the stock is cheap is of the debt will be refinanced, the stock is not going to go to zero, so things are fine in terms of the debt. The second one is lower growth, which is actually understandable. And the good thing is that Choice Hotel has a lot of free cash flow and is trading at a 7% free cash flow yield. This is the highest the company has traded at over the last 10 years. So if they use 100% of the free cash flow to buy back stock, they're buying back 7% of the market cap every single year. So you're getting a 7% return on the low end for holding Choice Hotels. This is how I think about it. So the lowest return is around 7%. But you have the free cash flow. And the free cash flow has been expanded, I believe it was like 180 million. Now it's 373 million for guidance for 2024 and expected to go up to 542 million by 2028. So the way I think about Choice Hotels is very simple. You have a 7% free cash flow yield, so you're getting around a 7% return if we don't experience a multiple contraction. And from the company trading at a record low of 14 times free cash flow, I'm personally not seeing a multiple contraction. I'm seeing a multiple expansion from here. So on the low end, you're getting 7%. But on the high end, you could have a little bit more in terms of revenue growth. So if revenue growth, let's say, grows back to 5%, and you have the 7% free cash flow yield, it's around a 12% annual return. And you could have the potential of a multiple expansion. You used to trade at 26 times. Now we're trading at 14 times. So all these things together, in terms of a risk-reward setup, I think personally, as a reward way outweighs the risk from this price. On the low end, you get 7% return. Best case scenario, you could get up to 20% return if the company grows again, around 5-6% in revenues, and you have a multiple expansion after the debt situation is settled from 14 times maybe to 18 or 20 times. There's just a lot of upside for Choice Hotel. I think that Terry Smith is also saying the same thing for him to be buying the stock, even though it's not the highest quality company ever, but maybe for him, it's trading at a very attractive price, and now it's trading well below what Terry Smith bought it. He bought it around 120. Now it's trading around $109 per share. So I really like Choice Hotels. Choice Hotels to me is an undervalued stock that still offers some quality, 7% on the low end, high end is 20%, good risk reward setup. So I really like it here, and I'm considering owning the stock myself. The second stock that I like, and it's not trading as cheap as Choice Hotels, of course. This is more of a quality company trading at fair value. And this is a stock called LVMH. LVMH, I bought it before when I shared it on YouTube a few months ago, and I made 29% on it in 2 months. It was an amazing gainer for my group, for my own portfolio. And I sold the stock around 183 or 184. Now it's sitting at $158 per share, down 11.5% year to date for this pretty good company, LVMH, and I'm considering buying the stock again. I'm going to tell you exactly at what level I believe it's a buy. But for LVMH, to me, it's an amazing company. Most of you are familiar with some of the brands that LVMH own, Tiffany, Tagger, Hublot, Dior, and even Sephora, which is a competitor to Ulta Beauty, and many different brands. Most of you know that stuff. It's an amazing company, and they do have some pricing power, even though things have been very slow for most retailers. A lot of retailers declining and other brands declining in terms of organic growth. LVMH was still able to post a 3% organic revenue growth in Q1 of 2024, which is not the best, but for a slow period for most retailers and most companies in general, I think this was pretty good from LVMH in the first quarter. In terms of the specifics, United States was 2%, Japan massive 32%, Asia excluding Japan was negative 6%, Europe was 2%, total was 3%. It's not the best or the most impressive number ever, but I think LVMH at 3%, it wasn't too bad for the first quarter of 2024, and it will likely get better in the future, in my opinion. In terms of the historical growth for the company, I'm going to try to keep it short. It's been around 7 to 8% earnings per share growth, and pretty close to 9% actually for the future, around 5.8% expected for 2024, then around 11% for 2025, and around 9% for the future. So for me, the way I think about LVMH is kind of the same way I think about Choice Hotels. I'm seeing around an 11%, or I say around 9% EPS growth average over the long term, which I think is achievable. And then you have a dividend. The dividend is 2%. This is more around an 11% return for something like LVMH. But LVMH could also experience a multiple expansion. Now it's trading around 21 times earnings. The mean was around 24 times earnings. So you're getting around the 8% or 9%, I should say, earnings per share growth average. And I think this is very sustainable for a company with amazing branding power and pricing power like LVMH. You also have the 2% dividend. This is like an 11% return on the low end. And you also have a potential multiple expansion from 21 times back to 24 times. Now, whenever I bought LVMH, it was trading around 19 times earnings. I bought it at $147 per share. And this is my personal target to buy the stock again. So I think LVMH right now is not really bad. And it's not at the highest growth ever. This is why I sold it. To me, it's more of a shorter term thing, and I can, buy it on bad sentiment, sell it on good sentiment. Because if I hold it for the long term, you might average 11, 12% a year. But I think it's better to try to maximize the short-term potential with a mature and large company like LVMH. But for me, LVMH, $145 or below, I'm a buyer. I would happily buy the stock and dollar cost average down. And it's just a good risk reward setup for both ones. It's not high risk for any of these two stocks. Both of them have low risk and they have decent upside potential in my opinion. And I share what I do in my own group. If you're interested in joining, this is the link over here. But thank you for watching the video. It's not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.